All right, the only thing we have left is, for Project 1 anyhow, the cash flow and balance sheet. There's the drop box for it, and this should be relatively easy and short. There's just a few things that we need to do because so much of this just fills in on its own. So let's take a look here at the cash flow for year 1. And then 1 through 3, or it's actually years 2 and 3. I guess year 1 is in there, but anyhow. So there's only the orange boxes that we kind of need to worry about, and in fact, really maybe only about 2 of these on this first year, and the subsequent years are kind of important. And let's look at, just go down the line, but first, additional inventory. For most of you, this just isn't going to be applicable, especially for those of you that don't really have an inventory type business. If you're a service business, go on, skip A and go to B. Okay. If you do have a business that has some inventory, is it possible that as your business grows, you may want to add? Now, the plan itself already just anticipates that it's going to replace inventory that you sell. But it's possible and good for calculating cash flow that, especially if you're growing, estimating that you're going to grow kind of rapidly, that maybe somewhere along the line here you would, put in an extra, $2,000 worth of inventory or some such. Okay? I'll leave that in there for now just because it'll allow me to show something a little bit later. And you might, that may be fine for a while, and maybe at the end of the year you want to add another $2,000. Okay, that's fine. If your business is growing slowly, probably not as big of a deal, or the amounts may be less, or if your business is bigger, if you've got a big inventory, then it could be more, of course. So that's fine. Let's just kind of leave those there. And again, that's kind of at your discretion. There's probably little that I would look at there and question, unless it's some gigantic number or some weird out of place thing. Owner's distribution. Remember now when I said on the payroll that you're not going to pay yourself. Okay, and the reason for that is the owner's distribution. Again, a little bit of a teaching moment here. I've got to subject you to that. When we talk about entities, and any entity besides a C corporation is called a pass-through entity, okay, meaning that the profits and losses pass through to the owners of that. Okay, so when you get to the income statement and you look at that, you actually don't have to do anything on that, but when you look at that, whatever that income is, the owner has to pay taxes on. Okay, if there's a loss, the owner gets to claim that against other income that they might have. Okay, but you get money out of the business by doing this. This will not affect your income. Okay, this is just a cash flow thing. You're just taking money out, but it doesn't affect whether or not you've made money. It's not an expense, right? Income statement only measures your income minus expenses, right? Okay, so everybody should have an owner's distribution. Now, does it have to start in month 1? No. Sometimes it might, depending on how your cash flow is looking. It might start a little later on. But let's just say that, maybe you're going to start out at $500 a month, and you want to do that for a few months, 3 months. Then maybe you go to $1,000 a month, and you do that maybe for the rest. That's pretty low pay. Maybe your business will afford more, but let's just leave it at that. Okay. Then I'm going to jump down here to dividends paid because that's just not applicable. Again, if you're not a C corporation, you actually won't pay dividends. I suppose if you had other owners or something, you could call it a dividend, paying it out to somebody else. That'd be kind of unusual, but could. I mean, usually I think there's another way to reconcile that actually in the owner's equity section. But okay, so let's look at that, and I don't have any of the other stuff entered into here, income, sales forecast, or anything like that. But it leaves me, obviously, if I look at this, with some negative cash flows, and I'm going to leave it like that just because then we have this line of credit, okay, repayment. Now, unfortunately, I don't have, I do have to go put some money maybe in my sales forecast here. 1 sales price per unit's 100, and so I'm going to do 30. Let's do 10. See what happens here. I don't know if that'll work out or not. No, let's do 15 might work. Sorry, I'm just kind of messing around with this. We'll see if this works. Just trying to create it so I can show you what yours might look like. So here, in this first month, okay, I had some sales, but I got some cash outflows. My total net cash flows were a minus 50, and so I have a line of credit balance down here of $50. Well, that goes on for 4 months. You know, it gets a little bit worse, but here I got money in month 2. It says I've got an operating cash balance of $400. Well, why don't I pay off that $50? Because I don't need to pay interest on it, so let's pay that off. Okay. Well, then here, when I got this inventory, I get another negative. Okay. Well, but here, you know, I could, it's got taxes in there because I've got to go back and, oops, I'm sorry, got to change my taxes, right? Okay. So now as we cruise along here, okay, any cash balance, boom, I don't have any more negatives. I probably should have left that in there, but let's just say I build up some more inventory here just because I want to show cash. Oops, I wanted that to be 2,000. I want to show some more negative numbers down here. See, but then I'm accumulating again some more cash here, you know, and here I might even want to pay back, you know, just $500 of it because I got $1,500 in my account. Now then, I can pay back the whole thing, right? The whole $650. So I put that in there so that I can eliminate this cash balance. Ooh, it comes back again here when I added inventory. So guess what? I might have to go to my next year's cash flow and see that, okay, I've got operating, I got $1,500 and I owe $178. Oh yeah, I can pay that off then. So I might have to go to the second and figure that out, and then I enter in that 178, and that gets rid of it. Okay, and again, I've got to enter in here if there are any additional inventories, but there very well might not be. But I have to enter in here then some more owner's distribution. Of course, that's going to screw up my cash flow some more. So let's just delete that because it's going to goof it up. And let's extend this out. Oh, well, I can't do it here and I can't do it here, but by golly, here I can pay off that 178. But I still don't have enough money really in the account, and so I'm not too fond of doing it there. Maybe I'll do it here. Okay, and that's fine. So there's no magic month necessarily that you would pay that off. Okay, because you may want to keep some money in that account. And in fact, I think on the additional inputs, you can put a minimum, desired minimum cash balance. You could change that. Okay, and that would keep your checking account at a certain amount. You wouldn't be able to go below that. So that's kind of it, right, for the year 1 cash flow, and then years 2 and 3 cash flow. Oops, I got to come up here then too, and maybe I'll continue at $1,500 a month for my owner's distribution, and I don't get into the negative on there. That'd be kind of typical, right? For business first year, I might need a line of credit. Yeah, I might go into debt a little bit on the short term there, but by this time I might be able to get that, I might be able to get that done and not need it anymore. That would be kind of typical. So if yours looks like that, that's fine. Just make sure that if you have this line, and you may not, right, based on your cash flows, you may not have a line of credit, but if you do, make sure you pay that off. Okay, we're going to look at, just glance at the income statement. It's got some stuff on here, but you can see it's all white, so there's nothing you're going to have to do to that. You don't need to enter anything. In fact, you'll goof things up if you do. And the same is true here for years 1 through 3. Again, it's all white, so if you enter something in there, you're just going to goof it up, more or less. But then there's an exception here when we get to the balance sheet. Okay. Odds are, if you've done everything, what's going to happen is this column, first year, is going to be balanced. But when you look at yours, this is, and this are probably going to show up in red, probably a nice bright red. okay? And it'll say warning, not balanced, okay? The reason it's not balanced has to do with prepaid expenses and possibly other initial costs, and it could be one or both, okay? But for most people, it'll be both. And that's just these 4 cells. So this is the only thing you need to do on your balance sheet, is that those are probably in parentheses. What happened here when I requested that you change the amortization for the additional inputs to 1 year, okay, it changed the way it shows these prepaid expenses and other initial costs on the balance sheet, and it kind of goofed it up. Okay, and that's partly my fault, but I preferred that just because I don't think we would normally, for most of our small businesses, amortize those out over 3 years. I think we would amortize them out over 1 year, but the formula in here is based on amortizing those out over 3 years. And so all you need to do is come to these 4 cells, what is that? E12 through F13. You highlight them like that, hit your good old-fashioned delete button. Okay, it's protected, so I'd have to unprotect that. Again, review, unprotect. Okay, now I can hit my delete. Boom. Okay, it actually deleted out that the formula, and that's fine. Okay, now yours should say balanced. Okay, it should. So if it doesn't, send it in and I'll figure it out and send it back to you. But that's it. And for the cash flow and the balance sheet, not a lot. You know, again, you should end up with the 3 balanced down here. And guess what? You know, if you get to that point and everything else looks good, you're going to be done with project 1. So congratulations, and on to project 2 really soon. Signing off.